Thank you.
Good morning. Good morning. I thought before Amita the way starts with a very heavy topic on various NAFRA orders which has been passed since July 2020 and it is still coming. So as of today around 80 orders have been passed. But before that I thought let us discuss the entire sequence of event. That why there was a need to have a oversight on the auditing and accounting profession. Most of you would have heard the description that the auditors are watchdog and not the bloodhound, and this description was came into place in the year 1896, which is like around 130 years back, and we need to basically deliberate whether that the terminology which was coined in terms of what would be the role of auditors, how that is relevant as of today. This description was first basically touched upon by Justice Lopez in the case of Kingston Cotton Mills to describe the role of auditors more as a passive guardian rather than being a fraud detective agency. Now, in the year 1896, there was no requirement for the companies to publish or file the annual accounts. There was no legal requirement to appoint auditors, and the duties of the auditors were not basically specified. In that context, Justice Lopez basically said that the auditors are just passive guardian rather than being a detective agency. Now let us see that how the law has evolved, like from that year where there was no statute governing the role of the auditor as compared to that what we have currently in the legal basically environment. So I would start with the incident which took place in the 1920s, whereby one Sweden entity they were planning to give a huge loan to European government to rebuild up their economies, and that entity set up an American subsidiary, and they raised funds by issuing stocks and bonds in the US market by promising the investors that they will get 20% dividend for the purpose of investment. They kept on raising the funds and they kept on repaying the dividends. So the dividend was being paid out of the capital. Slowly this got unearthed, and in 1932 the promoter of this entity committed suicide, and then it was came to the notice that between 250 to 400 million dollars has been lost by the investor. And because of this incident, there was a birth of US Securities Act 1933, and SEC came into play, mandating the companies to publish the audited accounts before they go to the public to raise the money. So that time the requirement was only to publish the audited accounts where the company was going to the public for raising the fund. Immediately after that, one more incident took place whereby the promoter inflated the assets and siphoned off the money, and again the law got amended, because up till now the management used to appoint the auditors. So SEC came out with a regulation stating that the independent board member should nominate auditors, and it has to be approved by the shareholders, and the auditors also should refer their report to the shareholders. The entire mechanism of the appointment of the auditors has undergone a change. Then various fraud took place, and the law kept on getting amended to basically take care of the public interest. On the turn of this century, a major fraud took place, which was Enron fraud. We all would have heard about the Enron disaster. Of course, it was a management fraud, but the questions were being asked that what the auditors were doing. So it gave a birth of Sarbanes-Oxley Act, SOX, and PCOB, a body got constituted to oversight the work done by the audit. So question came that who will do the audit of the auditors, and hence the PCOB came into place. This was in the year 2003. Even our Chartered Accountants Act undergone a change, and in 2006, and the Quality Review Board got constituted to review the work done by the auditors. But up till that point in time, it was more like a self regulations. The professional body itself, they were designing the auditing standard, they were designing the accounting standards, and they were themselves were doing the review of the other basically auditors. Then Satyam incident took place, and Indian regulators decided to fall in line with what was the practice prevalent in the large countries like US, Japan, Australia, UK. So the Companies Act 2013 came into play, and there was a provision to set up NFRA. However, NFRA provisions did not get notified until 2018. So there were a couple of other incident took place after Satyam, and that is how the NFRA came into play. NFRA basically, without being an independent, you cannot perform the role of performing oversight on the auditors, and hence the NFRA is an independent body, independent of the professional body, and without the empowerment, the regulatory body cannot exercise its role. So today NFRA has lot of powers in terms of levying fines on the auditors who have not complied with the auditing standards, and also have a power to even debar the audit firm. The overall framework of the NFRA are two segments. One is reviewing the role of the preparer like CFO, management, board of directors. So they also have one more wing which looks after financial reporting quality review to ensure whether the companies are complying with the requirements of the accounting standards, and if there are any violation, they don't have a power to levy penalty. They refer those cases to the central government or whichever is the regulatory body governs that particular entity. But as far as the other arm which is concerned, which oversights the role of auditors to review whether they are in compliance with the requirements of the auditing standards, they have full freedom to basically pick up the entity and review their working paper files and then come out with an observation. Initially, when NFRA started, the focus was more on the entities where there were in public news, where any basically misappropriation or fraud took place. But often now they have started independently reviewing the quality of the work which is being performed by the auditors. So with this background now, under the Companies Act, the auditors, accounting standards, auditing standards have been, everything has been laid down under the Companies Act, and we need to basically redeliberate whether the initial phrase that the auditors are watchdog and not the bloodhound, we need to rethink on that proposition. With this background, I would welcome Amita to discuss in detail that up till now what kind of orders have been issued and what kind of the observations which are coming out. There is no rocket science when you go through the gist of the case. It is pure suggests the non-compliance with the requirements of the auditing standards and the professional skepticism that need to be there in the mind of the auditors while performing the audit. Well, I welcome Amita to take it forward. Thank you.
Yeah, good morning everyone. So as Manoj mentioned about the history of NFRA and how it has been set up, I'll take it forward from here. So few statistics of NFRA. Till date, NFRA has issued 80 orders, and out of those 80 orders, 44 orders were issued to the engagement partners, and the 13 orders were issued to the proprietors, and the partners and firms, they have issued 23 orders. Most of the orders have come in the financial calendar year 2023, approximately 65% of the orders, and the remaining for the 24. These orders were pertaining to the audit files which is being picked up by the NFRA, which covered 4 groups. 4 groups of entities, were 46 orders were issued to only 4 groups of companies, and 26 companies were issued 34 orders. These orders were based on the inspections of the NFRA have concluded with debarment and the penalties to the engagement partners or the firms up to 1 year to 5 years, and in some cases the firm has been debarred for 10 years as well. The penalties were also ranged from 3 lakhs to 10 crores of rupees. How the NFRA has picked up the files for the scrutiny. In most of the cases, the files were picked up based on the regulator's reference to the NFRA authority. Maybe the IT department has found some irregularities in the filings. SEBI has reported to the NFRA for the inconsistency or alleged allegations against the company. So there is a requirement, or FRRB reviews are also happening by the ICI. ICI also referred to that. In very few cases, the NFRA has suo moto picked up the auditors for the audit file reviews based on their reporting under 143.12. This is the summary of the inspection period which they covered in 2020. It was covered 17-18 inspection was the file for which the auditors have done the audit. 21 there were no orders issued. In 2022, inspection period was 16-17 and 19-20. And in 2023, which is the highest number of orders were issued in that year, which covers inspection for the audit files for financial year 12-13 to financial 2021. In 2024, they cover inspection period of 2014-15 to 2020-21. And in 2025, up till date, they have issued one order, which is for the financial year 2017-18. Some of the key observations which I could gather from the reports which I have reviewed is in 2020 focus was on going concern, audit documentation, self-review threat. 2022 also to audit opinion, loans and advances, non-performing assets. 2023, as there were many orders, many files were reviewed, the areas of focus is also increased. If you see the consistency in all the 5 years, the orders which have been issued, going concern, loans and advances, audit opinion, and related party transactions are the key ones, which the NFRA has found irregularities in terms of the documentation or the audit inefficiencies in the audit file documentation across the years. These are just the synopsis of the observations which areas related to the like loans and advances. 25 orders were having observations related to loans and advances. Acceptance of audit as well. Audit opinion, 26 orders were having observations regarding audit opinion. Related party disclosure, 16 orders were there. 13 orders were on the going concern. EQCR reviews, 25 orders were issued. So on for the branch audit acceptance, inventories, materiality, consolidated financial statements, investments and revenue. Here I am going to take up the few of the cases which I have got the understanding from the learnings from the NFRA orders. One which I start with is related party transactions. One of the main instances which the observations for NFRA was that business rationale. Was no documentation noted in the file for the business rationale for the related party transactions. So to give an example, fraudulent diversion of funds. The funds were diverted from A limited to B limited, B limited to C limited, C limited to D limited, again from D limited to A limited. Like circulation of the funds were there. The company has advanced loans of around 4,000 crores to 6 of their subsidiaries, which were subsidiaries of the listed entities. And out of these 6 subsidiaries, 5 subsidiaries were not having any business relationship with the lender entity. So that circulation of fund were not documented or were not able to find out. How they could not do it? Because there was no testing performed. There was no agreements to entered into when the loans were granted. Generally, the company used to make the payments to the vendors or the suppliers through RTGS or NEFT mode. But when there were transactions with the related parties, the company uses the checks while making the payments. So this was also the indicator why checks were issued for the related party loans and advances. The business rationale for the loan, why was the loan is given, it was very, very general, not documented. The utilization of the loans were also not verified. Okay, what was the loan given for and used for? In one of the instances, loans were given, the board has approved the advances to the company for purchase of raw materials around 500 crores. The company has advanced loans for the purchase of materials of around 4,000 crores, 4,200 crores approx, which was much, much higher than the approvals. And the yearly purchase which the company used to buy from the parties was very much low, around 70 crores. The advances were much higher than the actual capacity of the supplier related party to give that matter of materials to the company. So all these were very quite evidence that the company was not in the business operations of the companies were not of that size which could cater to the needs of these materials. Another was one on the disclosures. There were inconsistencies in the work papers, inadequate disclosures in the financial statements. There were work papers where the related party transactions were disclosed, like purchase of materials were disclosed in the work paper, but it was not there in the financial statements disclosure. Certain related parties which was not disclosed in the financial statements, but which were there as a related party in the previous years. So it was a party where there was the sale transactions, 100% of sales was to that party, and in the earlier years, it was disclosed as a related party. In the current year, the engagement partner has not noted that and continued with the management opinion that the party is not a related party. So it is very evident that we have to check from the prior related parties whether there is any missing of the missing parties in that. The transactions were disclosed in the net basis. Loans were given to the company, and there was a collection also during the year for part of it. The related party note disclosed only the net amount whereas the loans granted to the company. The requirement of Ind AS 24 is to disclose the transactions on a gross basis, not on the net basis. Another deficiency was that the A company has given loan to the B limited of around 530 crores approx, where the B limited has disclosed those loan amount is in the much higher amount. So there was mismatch in the disclosure between the two parent entity and the subsidiary entity. And being a consolidated company's auditor was unaware about this situation because it's a consolidation financial statements. So both the numbers were mismatched. So that was quite evident that there is some circulation of the fund, diversion of funds is happening between the two entities. It's the reconciliation is the process which we can consider while doing the related party note checking or the verification. Like opening balances we have from the last years or at the opening balance sheet. Then the transactions which are disclosed in the related party note minus the collection or the payments which are there in the bank accounts or the GL accounts and arrive at the closing balance. That closing balance should match with the GL accounts and should match with the related party note. This type of reconciliation will help to identify if there are any missing transactions disclosure. Another observations was on the arm's length transactions. The transactions under statement of sale price or the sale of business to the related party. Normally, the company says because it's approved by the board and the audit committee, the transactions are at arm's length. But there is a specific requirements for us as an auditors to report whether the transactions are at arm's length. So for that very beginning, we need to check with the client or the controls of the process what the client has to determine that the pricing are at arm's length. In this one particular instance, it was noted that there was a sales to a company which is related to the promoter, but much lower price than the other prices at which the goods were sold to the other customers. The auditor did not ask for any verification why there was differences in the prices. The valuation of the business was sold to another group company with a much lower price. The contention was that there is a valuation report available, external valuation report. But on scrutiny of the audit file, NFRA has noted that there was no valuation report provided in the file. There was no valuation report. The auditors have explained, they have cited the report and reviewed the valuations and it was proper, but there was nothing, no such sort of things were mentioned. So as per the auditing standards, the valuation report has to be audited by us, the assumptions used in the valuation report, the projection growth, estimates used in the valuation, the methodology used for the valuation needs to be verified and then accordingly documented in the file. We need to ensure that we comply with the auditing standard on relying on the work of the expert. If required, we can also involve internal audit expert to evaluate and to review those reports. Another observation was on that communication with the TCWG. So there was like a huge discount given on the business valuation. The same thing was never discussed with the audit committee or the TCWG in this case on the decrease in the sale price, which is not in the normal course of business. There was another instances where funds were given in multiple tranches. A Limited gave funds to the B Limited in different tranches within a period of a week's time. By virtue of that, that amount has gone to the another party. The another party, which was it was given as a land advance or an advance for purchase of a land. That entity has given those advance in turn to the relatives of the promoters. At the beginning of the year, the loans were outstanding. And in the next year, by the end of that year, the loans were repaid. Our amount was approximately 480 crores or so. So during the, there was no purpose for which the land, the advance was given. They have mentioned land advance is given. But the rationale for why the money has come back was very, very flimsy, like now the land is not required. So in a way, this 420 crores, 418 crores or so, were used by the related parties for their personal use and then given it back through circulation of the funds. Completeness of related party was also one of the observation where all the related parties were not identified. The management, the auditors have mentioned in the procedures that MBB 1 has been reviewed. There was a need for verification of the minutes or the organization chart and ensure that what procedures the company has to identify any missing related parties. So, which I just spoke about it, that the parties which were disclosed in the last year also needs to be seen whether it is the continuing in the current year as well. Loans were granted. Loans is the highest observations in the related party were granted. No disclosure of that has happened. One company has disclosed the loan, other company has not disclosed. Interest-free loans were granted. One more disclosure, completeness of related party disclosure. There was a non-fund based facility given, like a guarantees given by the holding company to the subsidiary company. That guarantees were not disclosed because it was a non-fund based. The engagement partner contended that there was no financial cash outflow or inflow in that case, hence it is not disclosed. But the Ind AS 24 requires any commitments also to be disclosed as the related party transaction. Another one was on the loans and advances. Lapses in the compliances with section 185 and 186 of the Companies Act. The approvals were not obtained by the company considering that they are achieving the exemptions of infrastructure company which is available under section 186. But there was no documentation in the file to ensure that how that exemption is applicable to the company. The company was not in the business of infrastructure. So 186.4, where there is a disclosure requirement to disclose the nature of the loans, the purpose of the loans and the amount and the rate, that was also missed disclosure in that. Another one was on the disproportionate relationship between the financial transactions and the level of operations of the company. As I said, the operation business size of the company, balance sheet size was around 1.9 crores. There were no revenue in the company. The company has granted advances of 130 crores to that entity. So at the beginning, very beginning, it's a very questionable thing. The auditors need to question. There are no operations in the company, and there are no plans also, and no business rationale of giving 130 crores to that entity. So this was the thing where there was the business size of the company and the advances granted, there was a mismatch. The auditors have not checked for the sanctioned amounts or the end use certificate, or they have not asked for the end use of that particular, how that money has been used by those companies. Recoverability of repayment of loans and reliance on comfort letter provided by the client. The huge loans were granted by the borrower and there were no assessment of how those loans will be recovered. Particularly, there were advances granted of around 1,040 crores or so, which were lying as an advance for more than 10 years. Management had believed the auditors believed the management that these advances were recoverable, but there was no documentation in the file why these advances are not yet recovered or not yet utilized. This was in some of the cases were given as advances for the construction of a unit, but they were not able to recover the money from the customers. So no assessment of why the ECL provision is not required on this particular advances were done in the documentation. Another one was on the contradictory audit evidence in the audit file. The confirmations which the auditors have sent were having different numbers than the numbers which were there in the financial statements. There was no reconciliation done and what is the reason for the differences in that. There was a mismatch in the audit work papers and the repeated disclosures, as I said earlier also. Netting of the loans and given and financial statement disclosure. In one of the instances, outstanding balances of loan were understated. The company, the borrower has issued checks to the company at the fag end of the year. These checks were not deposited in the bank's account, which is around 180 to 200 crores. The checks were showing as checks on hand. And it was like borrowers, bank, related party borrowings were termed as a bank borrowing in the books. Subsequent, the company was not having any amount in the bank account as well to honor these checks. As on that particular date, the company was having a balance of around only 0.16 crores. And the checks were issued for a huge amount. Subsequently, to the year end, these checks were honored. These checks were honored or collected by the company because the other companies has paid amounts in that company, and this how these checks got collected. So understatement of outstanding loans and advances from related parties, just to show a better picture, as at the year end, there were no outstanding from the related parties as at the 31st March. There was one instance on consolidated financial statements. The company had a huge amount of 1,860 crores of checks on hand. That was coming from the subsidiary companies. So the question here is the auditors have not inquired into why such huge amount is outstanding as checks on hand as on 31st of March. So in that instances also, the auditors are expected to check on that particular subsidiary. Maybe the auditors of the subsidiary or may not be the auditors of the subsidiary, but if there is a huge checks on hand balance coming from the line by line consolidation of subsidiary, the auditors are expected to inquire about what is the rationale of issuing the checks at the year end, what is the rationale why these checks were not deposited, and how it will be collected in the subsequent years. There were observations on inadequate assessment of the investigation reports. Particularly this is the case where the RBI, NBFCs are involved. RBI regularly conducts inspections for the NBFCs. It was noted that RBI has issued various inspection reports to the company. In one of the instances, RBI has informed the company to stop blending because there was a risk of controls on the corporate governance on the corporate loan funding of the company. The company has, the auditors have ignored, may have reviewed those because they have access to that reports. they have not taken cognizance of that particular facts in the risk assessment when they perform their audit of corporate loan funding. There were issues in the previous auditor's report also where they have qualified the loans portfolio, but the auditors have not performed enough risk assessment to ensure that whether there could be any fraud in that particular cases. So in RBI inspection reports were, the observations were not considered and the qualified opinion were issued, but there was a need for further verification, and after the audit opinion is issued in May, subsequent to that in July, the auditors have issued a report to, has reported to central government for a 14312 fraud reporting on the same corporate loan funding. So this was a very clear case where the auditors were firstly aware about the corporate loan issues were there. They issued opinion without any adverse opinion. They have later on issued a report to central government for the 143 fraud reporting. So the NFRA has looked up to this matter in that way. The auditors were well within our, so they should have reported the fact in the audit report itself. Even the AGM of that company was held after the July, where they reported the central government the fraud in August. So they said, and the AGM also, as per the auditing standard on subsequent events, the company should have, the auditor should have mentioned the facts about the same case before the financial statements are released in the AGM about this reporting to the central government about the fraud matter. So another one was no evidence in the audit file for the charges created by the borrower. It's for the lending business, normally the company gives the security, the borrower gives the securities to the lender. There were no charges created, a register of charges, there was no testing of the charges, what is the collateral value, what is the percentage of the collaterals covers the loan amount. There was no documentation as such on the file on the charges. No assessment of the value of the assets on which the charge has been created by the borrower, whether it covers the full value or not. Unusual land advances, which I just covered in the rated party portion. Deviation from the lending policy is not evaluated. Unusual increase in the loan sanction. The company has a formalized loan sanction policy, which is also required by the lending institutions. There was no verification by the auditors to ensure that the processes of the loan or the set controls are been tested or followed by the company. There was only documentation in the file was the loan approval. In few of the instances, loans were disbursed without having the sanction or approvals. There was no assessment of the credit, assessment of the borrower. There was no testing on the interest rate, whether it is being charged as the arm's length, whether it is being across the same loan group with the same interest rate being charged. So, examination of the deviation of the credit policy, the process followed for disbursal were not followed. Another one was on the expected credit loss under provisioning, ECL not in compliance with Ind AS 109. As there was no testing done in the file for the ECL. It was mentioned that the company do not have, in one of the instances it was mentioned the company do not have ECL provisioning, hence the ECL provision is not made. So it is, if there is no provisioning done or no provision policy with the company, then it is like they do not have any evidences to provide for that. So then the audit report should have been mentioned about this fact that there was no such policy of ECL. In one of the instances, ECL assumptions or the model which are being used in the ECL, like probability of default, loss given default, were not evaluated. It is taken, considered, documented as ECL has been computed from the ECL model which is being used by the company. It was an Excel model, but then there are various assumptions and estimates used in this model. So that requires to be tested where the securities would have been considered, a probability of default, past history of defaults, or bad debts written off. That documentation of that was never there in the file. If there was a restructuring of the loan also, no impact of the restructuring, how it is being considered as appropriate, nothing has been documented in the file. Only the mention was that there was no ECL requirement. Where the asset size of the company of the loan balances, financial asset size was around 60 to 70% of the total asset size was of the financial asset. And there was no evaluation on why the ECL provision is not required. So the NFRA is not saying that whenever there is a financial asset, ECL needs to be provided for, but their expectation is that auditors have to document the rationale why ECL is not required, not because of the policy is not there. The rationale for the non-provisioning or the less provisioning has to be documented very clearly. There was another incident, loans granted to companies having no employees, very few assets. They were having the, in the asset size, 99% of the assets were the loan assets, and on the liability sides, 99.8% of the liabilities were from the borrowings from the group company. The company was not an NBFC, not a lending institution. It was just a company. So hence, such things also needs to be, this company was used to rotate out the money to the relatives of the promoters. So this was very quite evidential that the company is not in the business of the operations of the company. Company is not in the operations, and then it is just the shell company used to divert the funds. Another one is on the revenue part. For particularly revenue, there were observations on the controls. Not adequate testing was performed on the controls. There was an instances where GITC company was using an ERP system where GITC IT controls were failed, not operating effectively. The company, the auditors still relied on the, taken the approach of reliance on the controls and gone ahead with the testing of the controls and the substantive procedures. But the samples selected were not commensurate when the size of the company. Where there are no ITGC controls are failing, the inherent risk is much, much higher. The control sample size should have been much more, and there has to be some mitigation control of the manual controls when the automatic controls of the ITGC is failing. So there was no documentation as such on what are the other audit procedures auditors have followed to mitigate the deficiencies noted in the IT environment. Another one was on the low level of substantive evidence is selected because there was a low control reliance approach without testing the controls or with testing lower samples of testing. The substantive testing sample size were also lower. There was another incident of risk of fraud is being not evaluated in the revenue recognition. There is a presumed risk as per auditing standard for the revenue recognition. The company has recorded interest income of around 100 plus crores, where there was no rationale, there was no agreement on which the interest income has been recognized. The other party to whom the interest expense were to be recognized, they have not recognized any interest expense. Only the interest income were recognized by one of the party entity, and that entity got consolidated in the parent entity, which is the listed one. The parent entity has reported a profit, because there was no elimination, because the other entity had not recorded the interest expense and the one entity has recorded the interest income. Due to which the reported profit of parent entity, if that interest expense would have been accounted for and eliminated, the listed entity would have reported the loss amount. So this was a gross negligence noted by the NFRA while reviewing the papers of the auditors. Another instance was non-disclosure of reconciliation of the revenue as per the contract, and revenue is disclosed in the in the profit and loss statement. There is a requirement under Ind AS, the reconciliation of the revenue has to be disclosed, while revenue as per the contract minus any discounts, rebates or charges which are being reduced from those revenue, and then tally that number with the statement of profit and loss. The reconciliation was not disclosed in that. Accounting policies, there was an error in accounting policy where revenue was recorded at the fair value of the consideration received. Instead of revenue has to be recorded at the transaction price at which the goods are sold or the services are rendered. So there was a mismatch in the accounting policy as well in terms of the revenue. Recognition of revenue should be as per Ind AS 115, the 5-step model. The work papers do not disclose how the auditors have ensured that the recognition of revenue has occurred as per the Ind AS requirement of the 5-step model, where the performance obligations are identified, contract, who are the parties to the contract has been identified, how that particular entity has performed the terms, what are the services or obligations that to be performed, what is the commercial substance of these transactions, and the collectability assessment by the management. The management has to assess how that, auditor has to assess how the management is believing that the collect amounts which are being recorded as revenue will be collectible as at the inception. There were instances where the auditors have, NFRA has observed that there was a huge difference between the GST returns filed and where the revenue has been disclosed in the GST returns vis-a-vis the revenue which are there in the disclosed in the financial statements. There was no reconciliations prepared or reviewed in the file where there was a, because it's a public level, it's a returns which they file with the authorities. It's clearly available with us also and with the client also. So there has to be reconciliation. There could be mismatches in those cases, but reconciliation has to be done. Okay. There were sales invoices with not matched with the dispatch orders. The sales invoices, whenever there was a recognition of revenue, the source of the sales, the customer order has to be traced back. The customer orders is the first source where the third party evidence is where the sales transactions have triggered. The customer order is must, the source order, and then tally with the invoices and the dispatch details. There was only documentation of the sales invoice number and the amount, and this is the sample size. So that was the only 3 columns the documented file was having it, nothing more on that part. So the requirement of, as per the auditing standard, it is nothing like NFRA requires us to do us. It is required that we check the source of the transactions and then till the delivery of the goods. Hence all the obligations as per India's 115 for the revenue recognition has been fulfilled and the revenue is recognized appropriately. There was no evidence in the audit file found for the cutoff procedures. Cutoff is also one of the significant risks, normally the presumed risk where the entities can play around when they want to achieve certain numbers in terms of the revenue. So there was no documentation how the cutoff samples were verified or what were the population considered for the cutoff. So to give an instance, the entity may have a delivery cycle of 3 days, 5 days or month. So we could have taken, the auditors could have taken the sample size, populations basis, the cycle in which the goods are delivered, and then consider the sample size and testing of those. So there was no evidence in the audit file for the cutoff samples. In one of the instances, the auditors have documented, the auditors have considered the cutoff as a significant risk and has verified the last samples and found to be appropriate. And that 3 samples were documented. So, but how that last 3 samples have arrived at, whether it is appropriate, not appropriate, nothing of that sort has been documented in the file. Another topic was on the trade receivables. No testing of reasonableness of the doubtful debts and failed to report non-provisioning of doubtful debts. Huge receivables were there in the file, in the financial statements. The auditors relied on the management's assessment of realizability of those receivables. They believe that the receivables are in the normal course of business. The company will be able to recover those amounts, and aging analysis were also there in the file. Only the aging was there. Basis the aging also, it was very quite evident that there were 40% of the receivables which were due for more than a year. Still, there was no documentation or why that provision is not needed in that case. No sufficient audit evidence in respect of substantial amounts of bad debts written off. So there was a history of bad debts written off in the current year. Last year, the company, in the previous year I mean to say, the company had a receivables which were very high, which got reduced to very insignificant amount. That reduction in receivable was mainly due to bad debts written off. The auditors did not inquire of rationale for why such a huge amount of bad debts is written off in the current year. What is the reason, or whether the initial transaction has to be questioned why the transaction has happened. It could be a rated party, it could not be a rated party, but then huge write-off in the current year requires additional professional skepticism to be applied and verify why write-off is required in this year. Auditors place reliance on the management representation letter saying that the outstanding receivables are fully recoverable. So only reliance on management representation letter is not required. The testing has to be performed, the invoices and the delivery and the confirmations needs to be sent out to the customers why the customers are not paying, the rational, business rational, whether the initial transaction was appropriate or not, that can also be questioned when there are huge receivables and no confirmations are also sent to them. Anomaly in the audit work paper and disclosure of current and non-current trade receivables. So in the file, work paper file, there was a outstanding of receivables from 6 to 9 months, 9 to 10 months, 9 to 12 months to 1 year, 1 to 2 years, and so on. There were in the file there was just the Excel file. It is not known that whether it is client prepared files or the auditors have prepared those files. But in the financial statements, the same were disclosed as a current receivables. So that needs to also be seen whether it is a appropriate disclosure in the financial statements. And even if we have obtained the aging from the management, the testing of the completeness and accuracy of the aging needs to be verified and documented well within the file. There was insufficient disclosure on the credit risk exposure, which is required under Ind AS 107. The Ind AS requires companies to disclose the default rate basis the aging of that particular receivables. The amount as per the aging bracket which the company uses, and the loss given default as well. There is an illustrative reporting requirement also, which is being given under the Ind AS implementation guidance by the ICI. The disclosures are also not there in the financial statements. And auditors have not noted that or not documented in the file why such disclosures are not given. Another one was no external confirmation of outstanding receivables were obtained and no alternative procedures were performed on the receivable balances. There was a practice of the company that company regularly used to send out the confirmations to the 100% of the receivables by marking CC to the auditors, asking for the balance confirmation as on that particular date. And if the confirmation is not received within 15 days, the balance is assumed to be appropriate. So this type of confirmation the auditors have taken in that file, which means that the auditors have not performed or not understood the requirements of the auditors to send out the confirmations. The auditors have to ensure that we send out the confirmation basis the samples and the materiality which we calculate and obtain the confirmations and then check those confirmations. If the companies denies or access or denies us to send out the confirmation, and that needs to be brought out separately in the report considering the amounts involved in the receivable balances. A negative confirmation is also one of the method of sending out confirmations, but that can be applied only for the homogeneous transactions or homogeneous balances and very insignificant balances or percentage of the samples selected. That cannot be done for the 100% of the population. In this particular case, the confirmations were anyways not sent out by the auditors, were sent out by the companies. No evidence in the audit file for verification of the security of the trade receivables. No aging analysis were performed by the engagement team, and no evidence of verification of subsequent receipt. Same, the disclosure was that the debtors were secured debtors, but the securities were not documented in the file or not tested in the file how this has been presented as a secured receivables. Another observation was on the going concern. This was like there is a separate reporting also requirement by the auditors on the going concern. There was observation on the failure to discharge the duty of the auditors on assessment, how the management has assessed the going concern in first place, and whether the auditors have asked for the management assessment. There was no evidence in the audit file that auditors have asked for that information about how management believes that the company will be going concern, at least minimum for the 12 months after the reporting date. So there was another instance where the management has given the forecast for the next 12 months, and then the auditors have taken that forecast in the file and documented basis this forecast, the going concern assumption seems to be appropriate. But there was no documentation to support how the forecast has been prepared. What are the cash flows which they considered? What are the basis or assumptions they considered for revenue generation, what they have, what increase in rate they have considered, what are the outflows they have considered, whether the estimates were approved, whether the estimates are based on the past history, or what do they have the confirmed orders. The reports were signed actually 2 months later the year end, whether the 2 months actual data matches with the forecasted 2 months which was given for the auditors to verify. No such testing was noted in the audit file. There were instances where the net worth of the companies were eroded. There was a declining revenue in the companies. The current liabilities have also increased in year-on-year increase in the current in the year. The receivables recoverability was also at risk. These indicators were there in the file, which was, but still there was no observations or comments on the audit report on the going concern by the auditors. So the evaluation, it is not necessary in such a scenario every time there could be observations or comment on the going concern, but the evaluation of those, because there were contradictory evidences available in the file, it's there in the company, but still the going concern assumption is reported as appropriate. So that contradictory evidence has to be documented why the auditors believe that there is no issue on the going concern of the company. There was another observation on the audit opinion. There were instances where issue of qualified opinions on standalone financial statements and consolidated financial statements with 11 and 15 qualifications respectively. The qualifications were financially having impact on the financials. Their qualifications were pervasive, whether a huge qualifications with significant number of qualifications. It's possible the auditors may have to assess for whether there is a disclaimer of opinion required or adverse opinion is required. So EOM cannot be misused for in place of adverse or the disclaimer of opinion. The basis for EOM has to be seen. EOM is required where there is a sufficient appropriate audit evidence available and with a note and disclosure in the financial statements. In certain cases, there were the auditors have mentioned in absence of confirmations or the other evidence procedures, we could not confirm the recoverability of the receivables. If the auditors were not having any access to the information or not able to perform any audit evidence, then it may call for an adverse opinion or the disclaimer of opinion instead of emphasis of matter. So that observations was that. One of the observations was that there was non-consolidation of a subsidiary, which accounts for around 20% of the profits of the company, and, but the company has not been consolidated. There could be possibility of not consolidating that, but there was no documentation in the audit file why this subsidiary has not been consolidated in the financial statements. Misuse of EOM paragraph, EOM in place of modified opinion. Another case was unilateral extinguishment of trade payables. It was a huge amount of trade payables. This was the company has a usual practice of writing back of liabilities when they stop the business with the company. The company said it is in the normal course of business, and around out of the total revenue of 130 crores, 80-90 crores were of the write back of liabilities. Total income, after total income that. The company so they said that it is our normal practice, there is the amount is no longer payable to the parties, hence return back. It's old outstanding, more than 3 years, law of limitation applies, so we wrote back those liabilities. The auditors are expected to check for the confirmations from those parties. It is unilateral extinguishment of liabilities not permitted. Whether the creditors have waived those liabilities, whether they have forfeited their rights to recover those money, the auditors could have sent out the confirmations to the parties and ensure that these balances are no longer payable. It cannot be the customary practice of the company to stop the business and then consider that as a write back of liabilities. So that again calls for whether the purchases were genuine or not in the beginning. Audit reports, false reporting by the auditors. In few of the cases, it was noted that auditors have reported in the audit report that they have audited the statement of profit and loss, balance sheet, statement of changes in equity, and the cash flow statement. But the cash flow statement was not there in the financial statements. Not even it was there in the annual report when it was published. So company has to republish those particular reports. There was a disclosure wrongly reported that the company is into the business of the NBFC. where the company was in the media company, but the disclosure was mentioned as the company was in the business of the NBFC. So another instance is where there was missing disclosure regarding SBN notes in the financial statements, but the auditors have reported that there is a disclosure in the SBN in the financial statements. So this was why quite factually incorrect reporting were noted by the NFRA. No reporting of misstatements. There was internal audit reports. They have not. Internal audit reports were clearly mentioned that there was no physical verification carried out by the company for the property, plant, and equipment. But in the Caro report, auditors have stated that the company has carried out physical verification of property, plant, and equipment at the year end. So it was a contradictory evidence in the file, and there was no support. There was no physical verification report also in the audit file to support the audit report. Key audit matters, the company has reported key audit matter in the audit report, but there was no documentation to support the procedures as mentioned in the audit report. There was a planned procedures documented. Basis those planned procedures, the reporting was done. That is what being seen in the audit file. So whatever conclusion on this is that whatever we opine in the audit report, even in the Caro report or the IFC report, for each of the line item, I can say we should have the backup workings on, because these are the assertions as an auditors we are giving. So for each of the sentences what we include in our reports are to be backed by the relevant appropriate work papers. Basis the conclusion. Another one was on the inventories. It was the case where the auditors failed to obtain audit evidence regarding the existence and the conditions of the inventory. The auditors, engagement partners' contention was that we have been appointed as an auditor post 31st of March in April, hence we could not do the existence inventory testing. But that is not tenable. The auditors could have performed some alternate procedures to verify the existence of those inventory as on that particular date. Rollback procedures could have been performed. And the inventory balance was around 28% of the total balance sheet size of the company. Failure in evaluation of the inventory count no documentation of that has been also been done in the file. Sole reliance on the management representation letter that they have a perpetual inventory count physical, but there was no documentation as such in the file. It was like in the response to the NFRA, they said they inquired with the management on what are their process of physical verification and how frequently they do, but there was no such documentation noted in the file. Inventory reported Caro qualification and evaluated for audit opinion. Same thing in the Caro qualification, they mentioned that inventory could not be verified because there was some issue with the external authority, regulatory authorities. They have sealed the location, hence the inventory verification could not be performed. So this is like there was no audit could be done for the existence of the inventory. If the existence of the inventory is not tested, then the valuation of inventory itself will be questionable. So auditors could have assessed whether the audit opinion could have been modified for the particular inventory balance, which is the material to the financial statements. Just reporting under Caro as inventory could not be verified because of the regulatory reasons is not sufficient. Failure to verify the valuation of inventory. The valuation of inventories, there was no documentation in the file how the value cost has been arrived at. Or the file documented that the cost of the inventory includes specific cost. What does that specific cost means? Whether it's a purchase cost, direct cost, cost or NRV. The documentation of the cost were not documented in the file. Only the inventory statement was there in the file, which was that this statement has been derived from the ERP system. Materiality, there was a point on materiality where the quantification, the materiality was documented as high value of financial statement line items are material and are considered as for the materiality. Only high value. What is the value is not been documented. How that value has been arrived at is not documented. There is an auditing standard on audit materiality where it requires the auditors to assess the benchmark, which is critical for the auditors to considering the size of the balance sheet and the profit and loss, maybe the revenue, the profit or assets or expenses. Basis the operations of the company, what is the material balances which is required, which is to be used for the benchmark for the materiality, and how that materiality number is being computed. That also needs to be documented clearly in the file. basis for that particular discount or whatever rate you apply to particular account balances. There were some observations on the cash and bank. There was an unusually high amount of around 1,400 crores as cash and cash equivalents, which I just spoke on the consolidated financial statements, which was not coming through the subsidiary entity, which was not audited by the engagement partner. But because they were the auditors of the engagement partner, they are required to inquire why such huge balance is coming at the year end. Significant decrease in all of the instances of the cash and cash equivalents, around 50% of the increase. The revenue in that year of that company has significantly declined. There were no further confirmed orders to the company. So this calls for questions to the company that why such a decrease in the cash flows. If there is a decrease in the cash flows, will the company be able to repay, or will the going concern assessment is appropriate in future for the next 12 months to repay the liabilities as it arises. Another instance is on the deferred tax asset. Now, the company has created a huge deferred tax asset on the taxable losses. There were no evaluation in the file for the taxability when the company will be in the taxable profits in the future, because the losses can also be recovered within certain time limits. So that this is very critical points, deferred tax asset on the carry forward of losses. There was no assessment how this deferred tax asset will be utilized and when, whether there will be sufficient taxable profits available within that time limit period of 8 years to recover these losses. So there was no documented evidences in the file of recoverability of this DTA. Trade payables, write back of liabilities, failure to disclose interest on MSME. There was no disclosure in the financial statements of the MSME interest particularly. There was a payable and there was a payable to MSME, payable to others. But there was no documentation in the file, working paper file, why the interest did not be charged, or what is the testing done for the interest on the MSME. Because there were payable aging was there in the file, which showed that the payables were outstanding for more than a year. So it's possible there could be an interest liability on those particular MSME parties. But there was no disclosure, neither there was any working on the MSME parties. Contingent liabilities, there was non-disclosure of contingent liabilities. The company, in the audit file, there was an income tax officer's order was there, where around 17 crores of liabilities were charged to the company. The file, it was there in the file, but there was no disclosure of those particular assessment in the contingent liability. And there was no even the assessment of how this, whether this liability is remote liability. When there is a demand is remote, then there is no requirement to disclose in the financial statements. But there was no documentation in the file to support the case, whether it's a remote or it's a probable or it's a required a provision for that particular liability. The engagement partner replied that they believed on the management when they inquired, but there was no such documentation of the discussion with the management on those cases and the conclusion there too. Another one on the evaluation of the material cases, evaluate the document rationale for non-disclosure of the related contingent liabilities. Consolidated financial statements, in one of the instances it was noted that the company had, in the audit file, the company had 2 consolidated financial statements. And one of the financial statements were matching with the financials which are signed by the company and the auditors. So there was no rationale why 2 sets of financial statements were kept. The numbers were quite different, particularly in terms of the profits. Profits were much lower in the earlier version. Another one was in the instances where the consolidation adjustment entries were not tested. There was no testing of any elimination entries. There was no documentation of testing of any minority interest, how that minority interest has been worked out. So this was the case when elimination entries were also not tested. Hence, if elimination entry would have been tested, then the other part, in recognition of interest income by one party and non-recognition of interest expense by the other party would have been known to the auditors at that point in time. So there was no documentary evidence on that in that file. Non-consolidation of certain subsidiaries and associate and joint ventures, but there was no documentation as such in the file why this is not required. Under Ind AS, it's possible the company may hold investments of more than 50% in a company, but by virtue of some agreement, joint venture agreement or other shareholders agreement, the controls are 50-50%, and that can be accounted under equity method of accounting. But that documented rationale and the memo has to be there in the file. Then what is the, why this, even if the shareholding is more than the 50%, that it is not accounted as a subsidiary, it is accounted as a joint venture, as an equity. Two set of financials I have discussed. Another comments was on the acceptance of the audit. The audit was started before obtaining NOC from the previous auditors. Without any risk assessment, without checking on any background checks of the management. It is a mandatory requirement in case of at least the first year of audit, when the auditors are appointed, the NOC has to be obtained from the predecessor auditors. Auditor should commence audit only after the NOC received from the previous auditors. The instances where the NOC was not received and audit were commenced, in reply to the NOC, the previous auditors have given certain comments where they were having issues on certain recoverability and the qualifications, which were not, all the matters were not disclosed in the audit report. So these were the things which the auditors should have done, scrutiny of that particular NOC replies properly, and then plan the risk assessment procedures and then start the audit. Understanding of the business and the industry related risk has to be performed before we accept the audit or before we commence the audit. Independence requirements, the engagement partner of the audit firm, the daughter of the engagement partner of the audit firm were preparing the presentations, financial statements, because she was also a chartered accountant. Another firm was also set up by her. She was involved in the preparation of the financial statements of those companies, and the engagement partner of the audit firm was auditing those companies. So it was quite evident of the independence is impaired in that case. In one of the instances, the engagement partner were holding shares in that company indirectly through a relative in that particular company, around 24% of that particular stake, and still accepted the audit engagement and audited those financial statements. A branch audit acceptance and the branch audit. There was a branch audit was accepted without valid appointment or authorization as per one requirement of the Companies Act 139. The branch auditor stated in the replies to the NFRA, is the parent auditor has been appointed, so separate appointment formalities are not required for the branch auditor. But that is not the case. The branch, same procedures are required to be followed by the branch auditor as well as the principal auditors. Non-compliance with the standards on auditing by the branch auditor, non-evaluation of deficiencies. The branch auditor has noted the deficiencies in the financial statements of the branches. They communicated those deficiencies to the parent auditors, but the branch auditors has given the clean audit report for the branch financial statements. The parent auditors have relied on the branch auditors' audit opinion because the reports were clean. But the branch auditors cannot leeway with this, just communicating the issues or the matters to the parent auditors but not reporting in the audit report itself. So that was the observation. Engagement Quality Control Review, EQCR. There was no formal appointment of the EQCR being done, which is required as per SQC1. Wherever the EQCR were appointed, the competencies of the EQCR were not evaluated. In one of the instances, the engagement partner was quite senior, around 15 to 18 years of experience, and the EQCR partner was just a 1 year old or 2 year old professional chartered accountant. So there was no enough experienced EQCR to perform the work of an experienced, review the work of the experienced chartered accountant. So there has to be proper evaluation of the experience of the engagement partner, and the EQCR experience has to be seen, and then the EQCR needs to be appointed. There was another instances where proprietor firm was the auditor of that particular company. So then there was no EQCR in that because there was no partner in the firm. So NFRA has suggested that then the proprietor firm is not eligible to be appointed as an auditor of the listed entities where there is no EQCR, because the EQCR partner is a mandatory requirement to perform the EQCR. Another observation were there where there was an EQCR and the EQCR was performed, there was no evidence of the review being performed by them. There was only the testing of yes, no checklist was performed. The EQCR is required to document the discussions which they have with the management or with the engagement partners or the audit team. What are the significant judgments? They can question the judgments and how it has been resolved. Whatever comments they have raised also needs to be documented, and the resolution of those has to be evidence in the file. Only a sign off as an EQCR is not enough. The procedures what the EQCR reviewer has performed needs to be documented very clearly and elaborated. Other observations includes no communication with those charged with governance. Auditors are mandatorily required to discuss with those charged with governance or audit committee, and much well in advance. It cannot be only at the year after the audit is over. They have to discuss with the audit committee in quarterly meetings, the audit plan, the scope of audit plan, what are the significant risk, higher risk, or what are the key audit matters that they may expect to in the audit report. If there are any control related matters which they may have come across during the course of the interim audit, that also needs to be communicated. So not enough communication with the TCWG is the observations which NFRA has brought out. Non-reporting or application of incorrect financial reporting framework by the company. In one of the instances, the company has prepared the financial statements as per Companies Act 2013 instead of Companies Act 1956. This was like, it's a laughing thing, yeah, but this was the case. And the auditors have also not reported such deficiencies in correct financial reporting framework. Internal audit functions, there were observations in the internal audit reports on the non-recoverability of the receivables. The receivables were having huge disputes, litigations were there. There were no provisions made in the financial statements, and there was not documented in how these observations were mitigated by the engagement partner in their audit file. So internal audit reports are very critical. All the observations of the internal audit reports needs to be evaluated and documented in the file. How does it impact the financial statements as a whole? There was another observation on the utilization of IPO proceeds. Around 400 crores of IPO amounts were paid to the relatives of the promoters. So there was no testing done. Management auditors have relied on the management letter that how that money was utilized and documented in the file. So only reliance on the management representation letter is not needed. That has to be verified from the IPO proceeds. It is in the prospectus it is mentioned what for that amount will be utilized, and the testing of that has to be documented in the file. Non-compliance with laws and regulations. There were observations where NHB, like National Housing Board, has issued certain investigations, observations related to that company. The auditors were aware about those observations. The reports were there in the file. That reports were ignored. There were no verification has been done, and no observation, no testing has been performed. How the financial statements or the audit opinion may impact because of such non-compliances. In one of the instances of the RBI has mentioned in the report, the company has to close down that NBFC business as they do not meet the criteria of NBFCs. So that particular observations were also not considered by the auditors. So there were observations on the non-compliances with Section 185, 186 Companies Act non-compliances. The auditors have stated that they have relied on the company secretary when they gave us the confirmations that they have complied with all the compliances of the provisions of the Companies Act 2013. So this is not required. The auditors have to check. They may not check 100% of all the laws and regulations applicable to the company, but at least during the course of their audit, whatever observations which they come across and which is there in their audit file as well, that needs to be addressed properly to come to that conclusion in the audit opinion and accordingly reported. Only relying on management representation letter and not performing adequate audit procedures are not permissible. Thank you. Yeah.
check. Hey.
Thank you, ma'am. So we have a sufficient time for question answer. So if you have any question, both the speakers are ready to take the questions.
Yeah.
So I have a couple of questions on the points that she presented. I'm trying to understand what is NAFRA looking at. You mentioned a point of on related parties where she mentioned about the transfer of funds and the business rationale not being documented. Now, typically, the business rationale is presented to the audit committee, and that is what we take on board and then move on. So what was NAFRA looking in addition to that, or was that missing? That is the first point. On the point of the checks on hand appearing in the consolidated financial statements, I read the slide where it said that there was huge checks on hand in the consolidated financial statements. And the expectation is that then the consolidated principal auditor should have actually done a bank reconciliation for the subsidiary. But I'm assuming that that would have been done by the subsidiary and the principal auditor would have reviewed the work of the subsidiary. So what additional, was that missing and what additional should have been done? And the third one was in revenue recognition. You mentioned 2 points. You said that collectability in the 5-step principle was not documented. But typically we look at the 5-step principle and what additional needs to be documented on the collectability, specifically in that case? And was NAFRA's expectations that revenue reconciliation to GST records mandatorily has to be performed in all manufacturing companies? Those are my 3 questions actually.
Yes, so let me first give a overview about what is the important element in the financial statement. So revenue is always an important element in the financial statement. It's a key parameter and it is linked with receivable, cost of sales, and also with inventory, and that is why even in our auditing standards the revenue is always a presumed risk of fraud, and hence it is very important that how do you basically obtain the overall understandings of the business, industries, the company, and what type of contracts the company is having, whether it meets all the requirements of what you mentioned about 5 steps approach. The documentation of the auditor should clearly demonstrate that how all those 5 steps have been complied with, so that the company is able to recognize revenue. And occurrence is always basically a key item, whether the revenue is genuine or not genuine, and who is the counterparty is very, very important. So is it party genuine? Is it somewhere basically related with the promoter and the management? And of course the collectability, though in that 5 steps comes the last, whether it is probable to expect the collections from the counter.
What was missing in that particular case?
So there was, I can add, yeah, there was no documented how the collectability has been assessed by the management. So normally in a case where there was a huge sales has been done to one party, and then what is the cash flow generation from those parties, whether the company would have given the sales on the credit terms. So on what basis the credit terms has been arrived at, like 60 days, 90 days, whatever is the terms, and whether there was a payments received also within that time limits. When the past contract, for the current regular contracts, how the management believes that the other party will pay within the time limits. Because before entering into any contract with the customers, the management evaluates the customer's credibility as well, whether they have enough funds to repay, to pay us the amounts for the goods which have been taken. So that assessment was missing in that particular file.
So generally we are happy that in the subsequent period if the provision is made or the amount is being written off, generally auditors are happy that the management is making such provision. But the other question is that when at the initial point in time when the revenue was recognized, how that conditions of expecting the collections from the counterparty has been met. Of course, somebody may get a confirmation, but the confirmation is the willingness to basically make the payment, but whether the party has ability to make the payment or not, and hence that how the credit worthiness of the party has been assessed. So KYC is very important element and control which the management has to exercise to establish that yes, the management can expect collections from the party. The second piece which you mentioned about the related party. So many times it is like related party, and sometimes it is like maybe it is a related party but may not be disclosed that as such, and hence it is very important to understand what is the business rationale. So when you do lot of analysis, you may come out with certain transactions which looks unusual and not in the normal course of business. And hence during those phase the auditor is expected to perform some more testing and going beyond the normal audit process. The third question you asked on the consolidation piece.
No,
On
sorry. On the second one,
Yeah.
my question was the business rationale missing in the presentation to the audit committee? Because I assume that it is,
Yeah.
and was that sufficient or insufficient as a reliance measure?
Correct. I'll tell you, in the minutes where it was mentioned the audit committee approves the business rationale, it was documented as loans are up to this much of amount is approved to be granted to the subsidiary. But what was the rationale was not there in the audit committee minutes as well. Apart from that, there was no formalized contract or the agreements with the related parties where the business rationale has been documented. So in absence of those, at least the auditor should have questioned why was the loan given, at least what is the rationale for giving such loans has to be documented, and inquired why this was not formalized by way of an agreement. Yeah.
So NFRA is also actually educating the corporate world and the directors that the professional skepticism mindset, and the auditor would ask a lot of questions, and the management or the director should not get offended by asking those questions, because everything is laid down in the auditing standards, whereby they are bound to ask certain questions to understand the business rationale about the transactions. Many times it could be a related party transaction, many times it could not be it may not be a related party transaction, but it is important to understand the business rationale. On consolidation piece, recently of course our SS 600 is different than what is there in ISA 600, and we are allowed to rely on the work done by the other auditors. Of course, there are certain procedures which are being laid down, but recently NFRA has come out with a circular which is in line with ISA 600, where the parent auditors are responsible even for the work which is being performed by the auditor. Before placing reliance, they need to evaluate whether the work which is performed by the component auditors are adequate and appropriate for him to place reliance. If auditor reach to a conclusion that there are no enough evidences to demonstrate that work has been performed in line with the auditing standard, they are required to go ahead and perform certain direct procedures as well.
So my question in that particular case, which you had mentioned that the principal auditor should have ideally done the bank reconciliation. Nothing was done by. I'm assuming then nothing.
Yeah,
the observation was that the subsidiary auditor had not done.
NFRA's expectation is that the significant account balances of the consolidated financial statements, which are not being audited by the parent auditors, needs to be evaluated based on that materiality and the quantitative or the qualitative materiality. Basis that even if the principal or the component auditors have audited the financial statements, they need to inquire why such a huge cash and bank checks on hand were there. At least that basic inquiries and the testing of those is warranted. So in addition to the reliance on the opinion of
Okay, thank you.
And there could be a various way in which you do oversight on the work which is done by the component auditors. You either review their working paper. Earlier there was a restriction in terms of sharing work paper by the auditors, and it was up to the component auditors whether they want to give access to the parent auditors. But post this NFRA circular, it has been made very clear that the parent company auditors have right to access to the work paper of the component auditors, and many times it is also included as a part of engagement letter, also communicating those requirements to the parent management about these requirements which has been laid down by the NFRA. Yeah.
Yeah, yeah. Time limit का law for 8 years allows a man.
So is there a time limit beyond till what period they can go?
So as per the statute, even the management and us, we have to maintain the records for 8 years. So they have a freedom to go ahead and review the work papers for past 8 years. And many times what happens that basically one agency is already carrying out review, like for example SEBI is carrying out that review, and whatever is the observations of the SEBI, that is being shared with MCA as well as with income tax department, and then they also start their own process. Then MCA decide that this particular review has either it has to be given to SFIO or it should go to NFRA, and then again they also start reviewing what is the role of auditors. So if there is any question relating to the role of auditors, most likely if it is like covered entity, when I say covered entity, is that NFRA does not do oversight for all the companies. There are PIE which is defined under the Act, which is either a listed entity or unlisted entities meeting certain kind of threshold. It also includes the subsidiaries of those entities if it meets certain thresholds. But there are cases which, like NFRA is doing inspections going back in time, 7 years, 8 years, whatever is the extent they can go. Though many times the fraud may be a period prior to 8 years, but they are bound by a time limit which is there in the provisions of the Act. Then they go and stop up to 8 years, unless there are some matters which are already open. Then there is no time limit. If there are certain matters which are going on, then as per the requirements, the auditors are required to maintain working papers even beyond a period of 8 years.
Yeah, there was one instance where NFRA has took up the file of one of the auditor of FY 13-14, where the engagement partner replied that because of we are required to maintain the records up to 8 years, so we do not have that work papers in our office. So NFRA accepted those. So that was like NFRA can go beyond, but then what is your archival policy of the records and books and records of the professional firms are also important, and accordingly the replies were sent by the engagement partner.
So the question, I appreciate the answer which you give, but the problem is the inquiry may be on the company, but then you are expecting that the audit working papers and the all other documents should be maintained by the chartered accountant firm or the entity.
But the NFRA issues show cause notices to the auditors of the entity, not to the company.
No, very much. But so I'm just saying the answer which was explained that, you know, because there may be inquiries in the company from SEBI or other entities, be it income tax or GST authorities, because of which we are saying NFRA may take up the case, and therefore the chartered accountant firm is expected to also keep those working papers for those years.
Yeah, if it is
So
known.
for 8 years, even auditors are required to maintain account, and maybe it's a legal
Requirement.
this thing that what decision you want to take. But in my view, if the auditors has not received any notice, basically they can very well in their purview to maintain records only for 8 years, and records beyond 8 years, the auditors can destroy the record, maintain proper documentation of destroyal. In one of the case, it has also happened that 8-year period got over. Auditor did not destroy
They give the
working paper, and then the notice has come. And if notice has come, which is like beyond period of 8 years, but you have the records available as per the law, you are bound to submit those records for inspection.
So the other connecting question was, we have peer review board who is also looking at the audit working papers of the chartered accountant firms. Even NAFRA is now looking at the audit working papers. So do you think so there is an overlap in a sense, while peer review may not be having so much of powers in a limited sense, but NAFRA yes. So should there have been some bifurcation in terms of where NAFRA may have looked into the business rationale or the compliance of the accounting standards or auditing standards vis-a-vis the maintenance of audit working papers, which is being already looked by the peer review board?
So there are two things. One is that peer review is required for the auditors of the listed entity. And there, whoever wants to perform the audit of listed entity, it is mandatory to have the peer review certificate. So there is no option available that you cannot, you will not go through that process. That is independent. Whereas NAFRA is concerned, the NAFRA focus is to maintain the quality of the audit profession, and they have their own mechanism to select the audit entity as well as the client to pick up that where they want to perform the quality review. Up till now, it was more governed by observations made by other regulators, be it SEBI or SFIO or something else, where the fraud has already basically taken place. It has come in limelight, and one agency is reviewing the role of the management, and the role of auditors are being reviewed by NAFRA. Apart from that, means they started initially from the Big Four firm to review their quality control mechanism, and on their own they picked up basically some of the audit entities and they started reviewing, and based on that they came out with certain reports which is there in the public domain about what were their observations while doing the review of those entity. So means both are different, but being auditor, I understand your point of view that sometimes we get notice from ROC, we get notice from SEBI, we get notice from income tax office also for basically submission of either tax audit report or some sort of certification, and of course our institute is also performing review exercise. Some of the entities which does not get covered under power of NAFRA, those are under purview of ICAI, and they are also either they do suo motu or based on the complaint filed by some person, they do inspection of the audit working papers. Yeah.
You mentioned that basically, the auditors had not disclosed whatever were there was a 143.12, and in the next quarter they filed the 143.12. But 143.12 is always when the auditors actually get intimated of the fraud. And intimation of the fraud is when managements intimate the auditors, because it could be speculation. So in that particular case, when you said that the observation was that the auditors did not report it in one quarter but then reported it in the other quarter, what was missing?
That was, I can explain you. The 143.12 was on the fraud on the part of corporate loan funding by the company. That observation was already there with the auditors in the form of an RBI inspection reports, which was there in the file. And that they ignored. Even the previous auditors, while they replied to them on the auditor's report, also they have mentioned about the non-recoverability of corporate loans. In the NOC replies to the auditors also they have mentioned. And there were no new facts which has come across while reporting under 143.12 when they did in the second quarter. So the reporting which was done, the facts were already there in the early, year in which they audited.
Hello.
Should I qualify as because going concern concept is missing? Because no revenue is there. They are just booking. If I ask for money, they say future they realize something. What to do
So generally, naturally, when the means nobody does the business for making losses. So you need to understand basically what is their business plan. So like I used to do one entity which were into research phase. So they are just incurring expenses, and once if anything product get developed, then basically the revenue generation will start. So what you have to do is that we have to see that whether the company will be going concern for a period of 1 year. So if they have the forecasted projected cash flow about how much is the expenditure which is expected in the next year, and what is the plan to basically fund those expenses. And if, as an auditor, if you are satisfied with that, then there is no basically reason to. Yeah, so the management has not done the evaluation whether the company will be a going concern for a period of year. Then as an auditor, basically as per the auditing standard, one need to evaluate the impact on the audit report, and if required, maybe it could be a disclaimer of opinion or adverse opinion.
Yeah, there was one instance where the management has not evaluated the going concern assessment. So, in that particular instance, the engagement partner has also not requested or questioned the management about the going concern assessment. So that contention is that the auditors could have disclaimed the opinion on the in absence of any audit evidence available for the assessment of the going concern. Disclaimer. So that was. So there was also observation whether the qualification is required or the disclaimer of opinion is required. So that assessment of that particular why only qualification, why not disclaimer of opinion has to be documented in the file and then conclude in the audit report accordingly.
So going concern is the fundamental assumption for the preparation of the financial statements, and if auditor is not satisfied that whether it has been appropriately followed or not, then most likely it will be like a disclaimer of
because in absence of evidences, it mostly disclaimer of opinion.
Hello. In the earlier part of the this session, you have mentioned that one of the companies was giving loan to outsiders as RTGS, NEFT, and to related parties in the form of checks. So unless it is not a year-end or cut-off, what specific issues we have to look after? If in the interim period, the transactions, the loans are given in the form of checks and not in RTGS or NEFT?
So this was just the indicators of why there could be a possibility of fraud in terms of related parties, why the checks were used, whether the unauthorized use of checks were done or not. So why only the checks were used for the related party payments? And for the rest of the parties, the company uses the NEFT or RTGS. So that questioning has to be there just to instance why check payments are there. So that process of the controls, what the controls client has for making the payments, that needs to be evaluated. That could have triggered there is a unauthorized use of checks because the loans were advanced by promoter of the company who were having the checks of all the entities because they were the MD and CEO, so they were having access to all the checkbooks and were issued by them. So that was the instances. So if we would have understood the process and the controls on issue of checks, then this would have been flagged off by the auditors itself.
Thank you.
Yeah.
So currently, as per the estimates, around 6,000 entities are getting covered under NFRA's definition of PIE, and roughly around 2,500 auditors are basically getting covered. So you can imagine the extent of coverage which is there by NFRA and also for us.
One question here. So, with respect to those charged with governance, traditionally we have been, identifying the audit board committee as the those charged with governance. But recently, NFRA has identified that, because since the audit committee is a subset of the those charged and not the those charged with governance. So in that case, how do we tackle this scenario? Because they are saying that audit committee solely cannot be those charged with governance.
Yeah, maybe there is some, basically NFRA is coming out with their own version. They are asking questions but not providing solution, that then what it basically could be, because in the history how the entire structure has been evolved, even basically in the listing agreement, there is an important role which has been assigned to the independent director, and hence audit committee is the one which looks after the appointment of the auditors, the auditors remuneration, performance of the auditors, looking at the internal control framework, risk management policy, review of financial statements, review of the observations made by the statutory auditors and by the internal auditors, and for all perspective for auditors, like the audit committee is the one which is for those charged with governance. So if it is not, maybe one point they are trying to make is that it is there in the listing agreement itself that the auditor should meet independent director or the chairman of the audit committee one-on-one without the presence of the management. So what they are trying to say that maybe audit committee as a body where also the management take part in the proceedings of the meeting. The auditor should also meet the audit committee chairman separately in the absence of the management.
The remark was mentioned that the audit committee cannot overpower the management, or they cannot take the actions against the management. Hence, the audit committee cannot be considered as those charged with governance. Now, practically seeing to reach out to the direct board, bypassing the audit committee is not very much feasible and not practicable also. So, how do we deal with that?
So actually there are a lot of powers which are given to the audit committee. Of course, the audit committee do not take part on day-to-day affairs. They don't have a bandwidth also, and maybe expertise also somewhere to, if they are required, if there is a point where they need to basically do investigation, and that is where they have power to appoint an independent professional firm or independent person to support them to executing their role. There were many occasions where auditor has come across certain transactions which are unusual in nature and indicators of management override, and the auditors write directly to the audit committee chairman raising this issue and asking them to provide their viewpoint in the matter, and then wherever required, if they are required to appoint some independent law firm, they do appoint independent law firm. If they are required to appoint some forensic auditors which are independent, they do basically that. So of course, as an auditor, we have to do more and more communication with the audit committee, and if there are any matter, you have to basically communicate immediately to the audit committee.
Because by virtue of law, the audit committees are responsible for the governance of the company, because they have been set up for the governance. So in a very rare situation where audit committee is not governing, not performing their responsibilities as the governance, and in case if auditors believes that has to be also reported to the board, or again it has to be gone, but it can go through the audit committee and then to the board if required, as required.
My last question is, like NFRA is issuing orders from last 5 years or so. Only I think 1 year they have not issued any
2021.
after the COVID. So how it will be, and what is their role in future, including the training to the directors, what you have mentioned during the presentation, that I would like to know. I mean, they are really the only font filing, or they want to really build the profession in a better way, or in a better disclosure manner, or audit should be in a proper way? What is the objective of NFRA as a whole? Because I am seeing that in NFRA also there are many chartered accountant only who is helping or who is in the drafting of orders as well. So on your view on this.
So if you would have observed that NFRA is communicating regularly at all the forums, like in first session I think they had with WRC regional conference, then they had with CII, they also had a conference with the directors and also World Congress of Accountants. So they are regularly communicating, and they are giving rationale that what is their power and what is expected from the role of auditors. And they also quoted from Institute's magazine in 1998, Mr. Vahesh Maligam talked about the future of audit profession and the mindset of basically just not looking at the risk from the audit perspective, but you have to look at from the business perspective, that in the business what are the challenges and risks which are that, and focus on that more, and the role shifting from just like being a watchdog to basically the first party who will identify the fraud or management override in the profession. And they are, whatever order you would have seen, it's not, they are referring to a lot of the orders which are issued by PCOB in the US or in some other forum. So they are giving the entire rationale when they are issuing the orders, and they are quoting the procedures which are required to be performed as per the auditing standards. They are quoting accounting standards. So one simple thing is that when the accounting policies for the
Revenue.
receivables was disclosed, the financial assets, where it says that it's like a fair value, which is contradicting the provisions of the accounting standards, where you record the revenue at the transaction price. So they are reading minutely, they are also learning. So of course there are certain chartered accountants which are supporting NFRA, but if you look at the constitution of the NFRA, it's mainly like IAS who is actually heading the NFRA, but they are thinking rationally. They are also trying to look at going para by para under the auditing standard and asking the question that show us that this is what is written in the auditing standard. You show us the work paper that how you have performed those procedures.
So they are not asking us to verify the 100% of the line items in the financial statements, but the material items which bases your materiality computation, what has been determined, whether the audit procedures have been performed as per the auditor's standards, and the documentation of those procedures. Sometimes it may happen that we perform the procedures, we discuss also with the management, but there is no such documentation on those part. So this is what the expectation of the NFRA is. Whatever audit procedures have been performed in terms of evidences or in terms of inquiries and observations needs to be documented. But only inquiries and observation also may not help. That has to be supported by the corroborative evidences available in with the company. And then the work paper should have the conclusion which matches with the audit opinion which has been given. Yeah.
Right. Thank you so much, ma'am. Thank you so much, sir.
Thank you. Thank you.